Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today we're undertaking a deep dive into two really crucial but sometimes contradictory market events we've seen recently. Our mission really is to help you cut through what you might call political noise,
Right.
and find those genuine economic anchors that actually guide the markets.
That's exactly it. It's probably the most valuable skill for investors right now, separating those big splashy headlines from the hard data. So we're going to look at a specific case where a comment from the president briefly, spooked the oil market. And then we'll explore why a single Asian currency seems to be becoming this compass for global risk appetite. Really fascinating stuff.
Yeah, it's like, think of the global markets as a big highway system, right?
Yeah.
Often congested. We're basically trying to teach you how to read the reliable roadmap, the actual conditions, and maybe ignore the noisy traffic reports on the radio that turn out to be wrong.
Good analogy. Ignore the Twitter rumors about phantom traffic jams.
Exactly. So let's jump right in. First stop,
Mm-hmm.
this pretty unusual India oil dispute. Okay, so this story kicked off, I think it was October 15th, with a pretty surprising announcement. It came directly from President Trump.
Mm-hmm.
He claimed he'd spoken with Indian Prime Minister Modi on the phone.
Right.
And he said Modi agreed to stop buying Russian oil shortly. He framed it as a big win for the U.S.
Yeah, that definitely made waves in the energy world. But here's the key thing for anyone watching the markets closely. You have to watch the immediate official response. And on October 16th, the very next day, India's foreign ministry came out with a really strong denial. Quite unusual, actually.
How so? What do they say?
Why, they explicitly stated there was no phone call between the leaders on that particular day.
Wow. Okay, so not just disagreeing with the content, but saying the conversation itself didn't happen.
Precisely. That's a whole different level of contradiction. It's not just spin.
Hmm.
And India went further. They basically said their oil policy is driven purely by their own energy security needs, and what's best for Indian consumers, full stop.
Okay.
Then on the 17th, Russia chimed in too, sort of dismissing the remark and saying they were confident their energy cooperation with India would just carry on as usual.
So the market pretty quickly started seeing the original statement as, well, just politics.
Exactly. Political rhetoric, not necessarily economic reality.
Okay, so statements flying back and forth. Politics can be messy. But what about the actual, the hard data? The trade numbers? What did they show about what India was actually doing?
The reality check. Well, the data completely backed up India's stance. It showed steady, even increasing demand. If you look at the September 2025 import figures, India brought in 1.6 million barrels per day of Russian crude. Still very robust.
1.6 million barrels a day. And how much is that of their total?
That represents a huge chunk, 34% of India's total oil imports for the month. Russia is still firmly their #1 supplier, no question.
34%. That's not something you just switch off overnight. That sounds like a serious structural commitment.
It absolutely is. And to make sure that commitment can continue, they're also building up this parallel financial plumbing. Right.
You mean to get around potential U.S. sanctions?
Exactly. The long-term signal here is, frankly, much more powerful than any single statement or tweet. India and Russia are actively strengthening the rupee ruble payment system.
Okay, explain that a little. How does that work?
It's basically an arrangement allowing them to settle their oil trades using their own currencies, Indian rupees and Russian rubles, instead of the US dollar.
Which is the standard for global oil trades.
Right. So this move lets them keep trading while kind of insulating themselves from US financial pressure or, potential restrictions on using systems like SWIFT. It's a structural workaround.
So India's buying strong. They're building ways to keep buying.
Yeah.
How did the oil market itself, like WTI crude, react to that initial political noise from Trump?
Well, initially there was a dip, a temporary wobble based purely on fear, really. WTI crude slipped down towards the $59 mark right after the statement came out.
Just on the fear that India might pull back?
Yeah, the fear that the world's main engine of demand growth might suddenly leave the market. That's a scary thought for oil traders.
But you said temporary, so it didn't last.
Yeah.
Given how solid India's actual buying was.
Didn't last at all. Shows the power of a headline, even if brief. But the correction was incredibly fast. As soon as India's denial came out, and then the import data sort of confirmed the reality on the ground, the market did this sharp V-shaped recovery.
Back up to where it was.
Prices fully rebounded. Investors who look past the headline, who check the facts, they basically dismiss the political statement pretty quickly. They saw India's demand as a constant. In fact, you're seeing investment banks now actually raising forecasts, citing India's demand as this really strong price support.
Okay, so the lesson here for us, for the listener, beyond just check the facts.
I think the main takeaway is you absolutely must cross-reference these high-profile political statements, especially the instant ones like tweets, with actual economic data. Hard numbers, treat the political stuff as noise until it's confirmed by what's actually happening with trade flows or policy implementation.
And specifically on India,
Yeah.
you called it the new whale of demand earlier. Why is that role so critical right now?
Because India is pretty much the only major engine driving global oil demand growth at the moment. Chinese demand growth is maturing, Europe is flat. So India's consistent buying provides this incredibly strong, what we call downside stickiness for crude prices. It puts a very solid floor under the market.
Right. As long as they keep buying like this, it's hard for prices to truly collapse.
Exactly. It anchors the low end of the price range.
And this all feeds into that idea of India pursuing its own path, what analysts call strategic autonomy.
That's the core concept. Look, securing cheap Russian oil does two big things for India. One, it helps keep domestic inflation under control, which is huge for political stability and consumers. Two, cheaper energy massively boosts the competitiveness of their manufacturing sector.
Makes sense. Lower input costs.
Right. And this independent stance prioritizing their own national economic stability, even if it goes against, say, Western consensus, sometimes that's actually what makes India a really interesting long-term investment story. They're charting their own course.
Okay, so India's autonomy provides this sort of bedrock stability in the energy market. Let's pivot now to our second anchor. This one's in the financial markets. We're talking about China's currency, the yuan, or CNY. You're saying if India sets the floor for oil, the yuan is kind of setting the floor for risk appetite across Asia.
That's a great way to put it, because this is also a very clear policy signal aimed at stability. What we've seen recently is the People's Bank of China, the PBOC, doing something quite deliberate. For 8 trading days in a row, they've set the official USD CNY fixing rate much stronger than the market expected.
Stronger meaning the yuan is worth more against the dollar than people thought it would be.
Exactly. And crucially, they've consistently kept that fix below the key psychological level of 7.10 yuan per dollar.
Why is 7.1 such a magic number?
Well, currency markets often latch onto these big, round numbers or significant past levels. Historically, when the yuan weakens past 7.10, it tends to signal market stress. It might suggest the PBOC is worried about, say, exports slowing down, or maybe they're becoming more tolerant of capital outflows.
So by actively keeping it stronger than 7.0.
They're sending the opposite signal. It's the strongest, most consistent message of commitment to currency stability we've seen from them in, well, over a year. And this has actually helped weaken the dollar globally a bit, too.
Okay, so the PBOC is making the yuan stronger on purpose. Why does that action become this sort of aha moment, as you called it, that boosts investor confidence across all of Asia? Seems counterintuitive, maybe?
Yeah, it does seem a bit indirect at first, but it creates this positive ripple effect across the whole region for, I'd say, 3 main reasons.
Okay, let's break those down. Reason 1.
Reason 1. The yuan acts as the region's anchor currency. It's the de facto anchor for East Asia. Think about currencies like the Korean won, the KRW, or the Taiwan dollar, TWD, even the Thai baht. They tend to move quite closely with the yuan.
So if the yuan is stable or strengthening?
It makes the whole region look less risky from a foreign exchange perspective. If you're an international investor putting money into Korea or Taiwan, a stable yuan reduces the risk you'll lose money just because the local currency weakened unexpectedly against your home currency, like the dollar.
Okay,
Yeah.
It reduces that FX volatility risk across the board. Like a calmer sea makes all the boats safer.
Exactly. A stable anchor keeps the whole fleet steady, so that makes Asian assets generally more appealing.
Got it. Okay, reason 2.
Reason 2 is purchasing power. We often think of China as the world's factory, right? Making things. But it's also a massive consumer, a huge buyer of raw materials and intermediate goods from its neighbors.
Like computer chips, iron ore?
Precisely. So when the yuan strengthens, China's import purchasing power goes up. They can buy more foreign goods for the same amount of yuan. And that's fantastic news for places like Korea and Taiwan selling them semiconductors or Australia selling them resources. It means potentially higher demand from China.
Right. So a stronger yuan actually boosts growth expectations for China's trading partners.
Yeah.
It's like a demand signal.
Yes, exactly. It implies China can afford to buy more from the region.
Okay, makes sense. And the third reason, what's the policy signal here?
Reason 3 is all about confidence. When the PBOC actively chooses to keep the yuan strong, it signals that the government is prioritizing stable domestic growth. They're showing they don't feel the need to rely on a weak currency to make their exports cheaper and more competitive.
Which implies they think their domestic economy is doing okay.
It suggests they believe the worst of their recent economic turbulence might be passing. That underlying confidence from policymakers tends to spill over and reassure global investors too.
Okay, so 3 solid reasons why a strong yuan fix boosts regional sentiment. How do we as investors actually use this?
Eh?
Is the yuan now really the main compass for navigating Asia?
I'd say it's become absolutely crucial. The daily USD-CNY fixing rate is now a key leading indicator for Asian stock markets. Think about indices like the KOSPI in Korea or the Taiwan Stock Exchange Index. If the PBOC releases its fix in the morning and it's stronger than the market consensus expected, you'll often see foreign investors take that as a green light.
Meaning they start buying Asian stocks that day.
Often, yes. It signals stability, it signals potential demand, it signals policy confidence, so capital tends to flow into the region on those days.
So the old rule of thumb, just watch the S&P 500 to know where Asia goes tomorrow. That's maybe not holding up as well.
That relationship is definitely changing. We're seeing more differentiation, or decoupling as people call it. If the yuan is strong and stable, supported by the PBOC, Asian markets might actually hold up quite well, even if U.S. markets dip because of, say, worries about the Fed.
In the reverse.
And the reverse is also true. If the PBOC were to let the yuan weaken significantly past that 7.10 level, Asian markets could really struggle, even if U.S. markets are having a good day.
So you almost need to watch the PBOC's morning fix as closely as you watch the NASDAQ futures now if you're trading Asia.
That's not an exaggeration, frankly. It's become that important as a short-term directional signal for the region.
Okay, so if this strong yuan trend continues, which specific assets or markets should we be looking at as potential beneficiaries?
Well, first, obviously the currencies that track it closely. So the Korean won, KRW, and the Taiwan dollar, TWD, could continue to strengthen. Second, you'd look at Chinese equities themselves, both mainland and Hong Kong. Things like ETFs tracking the CSI 300 index, which is major mainland stocks, or the Hang Seng H-share index in Hong Kong. A stable currency boosts confidence there too.
Right, reflects that domestic stability idea.
Exactly. And third, don't forget the commodity exporters that sell heavily to China. The Australian dollar, the AUD, often benefits when markets expect Chinese import demand to be strong, which is implied by a stronger yuan.
Okay, this has been a really useful deep dive. 2 powerful lessons, it seems, for reading today's global economy. First, as we saw with India and the oil story, you've always got to verify the political headlines, even from the very top, against the hard economic data. Don't trade the tweet.
Absolutely. Cross-reference relentlessly.
And second, the Chinese yuan, specifically the PBOC's daily fixing, has become this essential compass for navigating Asian investment sentiment. Its stability is a huge confidence signal for the entire region.
It really anchors that whole financial ecosystem now.
So connecting these 2 big Asian anchors, India's energy demand and China's currency stability, what's the final, maybe provocative thought we should leave our listeners with?
Well, think about this. You have India clearly demonstrating its strategic autonomy and acting as the undeniable primary engine for global energy demand growth. That puts a floor under oil prices. Then you have China making a clear strategic policy choice to stabilize its currency, which in turn stabilizes regional financial sentiment. So the question becomes, how fundamentally stable is the global energy price floor now, almost regardless of short-term political spats elsewhere, and maybe more broadly? Is Asia, through these independent anchors in India and China, now truly starting to lead the fundamental direction of global commodity and currency markets, rather than just reacting to decisions made in, say, New York or Washington?
A lot to think about there. Is the center of gravity shifting?
That's definitely something for you, the listener, to mull over as you put together your own market view and strategy.
Don't forget to subscribe and hit that like button.